case study of stock that we liked. Unfortunately, it's gone up quite a lot, and this belongs to the asset bucket, where we try to buy this company stock that's trading significantly below its revalued assets. The company is called WINGT, and it's traded on the Singapore Stock Exchange. It started in 1955 in Hong Kong as a garment manufacturer. And what happened is that over the years they've moved into property development as well as retailing, both in Singapore, Malaysia, as well as in Hong Kong. They run big retail franchises here in Singapore as well as Malaysia, like the G2000, Topshop, Dorothy, Perkins, Fox, Uniqlo. They've got a joint venture, so that's one part of the business. And they're also very big into property development. WINGT is very big. They do quite a bit of high-end luxury condominium, as well as they have some commercial property here in Singapore. And they also own two listed companies, one in Malaysia, WINGT Malaysia, which is 61% owned by them, as well as WINGT Properties in Hong Kong, which is 34% owned by the holding company, which is listed in the Singapore Stock Exchange. When we started buying it, stock has fallen significantly because of the major developments, the property cooling measures in Singapore. The sixth measure, which was done about a year ago, the government came out to impose higher stamp duties on property transaction, and that kind of caused basically all property stocks in Singapore across the board to drop. And more recently, Hong Kong also just raised their taxes on property transaction, and also we've seen that something similar happen in Hong Kong too. We did our analysis and we did our guesstimate. The book value of the company, the stock, is about $2.50, and we estimated that the assets would be worth $3.30 per share, $3.40 per share. It went down to 90 cents, so it was 0.3 book. The stock has gone up to about $1.80 to $2. So it is still trading below its what you call a revalued net asset value of about $3.30 to $3.40. But the margin of safety will not be as much. And what we like is this company has a very good consistent track record of growing its book value, its asset value over time. And it has also been quite shareholder friendly. They've paid out dividends over the period of time. And so what happened was that when we bought the stock, the luxury market in Singapore was very quiet because of the additional stamp duties that was required on foreign buyers. Basically, nobody wanted to buy. Foreigners were very hesitant to invest in luxury condominiums in Singapore, and this is what they happened to build. So obviously the stock kind of took a beating because of that. And I think this created an opportunity for us to buy the company on the cheap side. Also, we know on the physical market what these properties are transacted at. So there are private market transactions which you can guesstimate or estimate the intrinsic value of this company. And so our investment thesis was confirmed when the Cheng family is the family that owns WINGT, made a partial cash offer for the company to bring up his stake to over 50%. So he made a cash offer at $1.39, and if you know the biggest shareholder, the family that owns and controls the company, is offering you this price, definitely he must have thought that the company is probably worth much more. Yeah, otherwise why would he be paying you $1.39? And following which, because it's a cash offer, they had to get an independent financial advisor to basically value the company, and the valuers came up with about $3. So that actually kind of confirmed our investment thesis on the value of the assets. And so because of that, I think the stock kind of re-rated over time as kind of the value was being realized over time. So that's how we came about investing in this stock, and we still hold a small position in this because I think it's still trading at a discount to its book value, but unfortunately because of the run-up, the margin of safety would be reduced. Yeah, so this is just an example of the asset bucket of stocks that we own.